So the relationship between interest rates and equities is a very complicated relationship. I would say that in general, the interest rates that matter the most for the equity market are actually long-term bond yields. Because in theory, the equity market is taking all future cash flows, profits, free cash flow to equity, and dividends, and discounting them back into the present using primarily long-term bond yields to do that. Now, when the Federal Reserve eases short-term policy, that can have varied effects on the market. If the Fed is easing in the context of a soft landing, like in the mid-80s or the mid-90s, the equity market can soar. On the other hand, if the Fed eases policy because of an oncoming recession, that usually happens in the context of a bearish environment for stocks.
We've been in a world of disinflation that has not come at the expense of growth. You see it in goods prices, you've seen it in wages, given the fact that wages have moderated without seeing a big uptick in unemployment. So we think thus far the Fed has been successful at engineering a soft landing. The question is, of course, where do we go from here? We are not making a recession call over the next 12 months, but what you do see within things like earnings forecasts for the S&P 500 is that expectations are pretty high for about 14% growth next year. We think the challenge for markets into 2025 could be that we're trading at high valuations, we have stretched positioning and stretched sentiment, all the while expectations are already at very high levels. If you start to see those EPS estimates or earnings estimates level off, that could start to be a challenge for markets as we think about forward returns. So we wouldn't be all too surprised for some sideways chop at least into 25 as we grow into these high valuations.
2025 has a lot of potential challenges for the equity market, among them geopolitical risk. Do the conflicts in the Middle East and between Russia and Ukraine get resolved, or do they perhaps intensify further or spread to other areas? Another question, do US consumers and global consumers hold up? If they don't hold up, that could put downward pressure on corporate profits. And then lastly, you have the lagged impact of the 2022-2023 tightening of monetary policy that around the world was the most significant period of rising rates since the early 1980s. Does that eventually slow down economic growth to the detriment of corporate profits and the stock market?